Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for September 8th of 2024. Okay, so we'll get started with the leading economic indicators here. We have this maybe a little hard to read, but we've got trend lines going all the way back to 1970s, and we have had a bit of a more recent uptick in the LEI, although it's maybe a little hard to see here, but it looks like maybe a little bit of a fish hook after a prolonged period of decline, which we were watching very closely, because there is this historical reference here looking at these prior economic cycles where these red shaded bars represent recession and the LEI declines corresponded with those recessions. And you can see in each of these instances here where we've hit the so-called recession threshold that we in fact have had a recession, including the COVID shutdown. Now we did hit that, but we have since anniversary that particular instance, and we're at least a year on now, and we haven't had a recession, and so I do think it supports the kind of the narrative that we've been talking about in terms of a soft landing. You will see some data here in the chart back this week that the economy does appear to be slowing, and I think that's natural and expected, and again something that we're not in the least bit afraid of. But the question is it slowing too much? And I think that's a little bit of the rhetoric that's injected a little bit of volatility here in anticipation of these rate decreases on the part of the Federal Reserve. But we still have a lot of things that are going for the economy, even if we're getting things like retail sales and wages that are slowing a little bit. But still, the overall backdrop is certainly not unfavorable. I'll leave it at that. This slide, we have the Atlanta Fed GDP now. This is their GDP estimate for the third quarter of 2024, which will be ending here at the end of this month. And you can see in their green line, they started off with something closer to 3, and then that held constant for a while. And then with the slowing data, we've had not only some weaker construction numbers, but there's also weaker maybe retail sales numbers that are kind of figuring into this a little bit. Now it looks like we're kind of coalescing around this 2% range, and you can see in the blue shaded area, this is the range of estimates, and then the consensus here is actually for something a little bit closer to 1.8. But I show this on occasion because the Atlanta Fed, this particular calculation, their algorithm and their inputs have done a very, very good job of predicting where economic growth on an annualized basis is going to wind up. We have beige book activity. You can see beige book. This is published by the Federal Reserve. This is a composite of activity across the various Fed districts, and you can see that that is a bit subdued. And again, this is on the backdrop of many, many decades of data. You can see the trend line outside of recessions is something generally a little bit higher than where we are right now. And again, when you have these dips that go below zero, that it often corresponds with recession. So we want to be careful. Again, history past is not prologue, but you should certainly respect history. And just like we saw in the LEI, we went negative in terms of beige book activity, and we have not seen a recession yet. We have had within the beige book, and there is obviously data, but there's also narrative in there too. And these are this is essentially feedback from the districts on what they're seeing within their district. And you can see that the word decline has gone up quite a bit since the last time we heard from all those districts. And so, there is an increasing concern of maybe an economic slowdown or outright declines. I think this is something that we should certainly pay attention to. But I think anybody looking at things objectively would say, when you've had tight credit, as we have had for quite some time, that this is only natural to assume that we're going to have some of this. We have job openings. We've been talking about this for many months now. You can see the number of openings. A lot of distortion in these numbers right here. What we are getting to is something that's closer, I'd say maybe normalized to where we were before the pandemic. But needless to say, we have had job opening declines. And at the same time, honestly, that we've not had a lot of spike in layoff announcements, which just means that that companies are basically saving money through attrition. They're not necessarily opening up the jobs that are being created with, with retirements and things like that, but they're not necessarily laying people off either. And you can see the latest reading fell a little bit short of expectations. Here we have that same data point. Here we've got the job openings in pink, and we know that they've been rolling over. And we plot this against the S&P 500. And what you can clearly see here is that there's almost never, and this goes back to about 2002. This almost never happens where you see the stock market go up with the labor market decelerating. And that's an interesting factoid that seems to have, the divergence seems to have started to play out here in 2023 with the emergence of some of those AI stocks, the Mag 7 that we've been talking about, and kind of the narrow leadership of the market, I think, has a lot to do with this divergence. But this is extremely unusual to have this delta and actually have these things go in diametrically opposite ways. So obviously something else to watch. And here we have job openings versus the unemployed person. So, the whole question of workforce stability and people that are out of the workforce coming into it and the labor participation rate. I mean, all of these things are pretty important as we monitor. You can see the convergence here of these data points, and that just tells you that the labor market is slowing down. We have several more charts on those circumstances. This is from Bloomberg. You've got non-farm payroll growth, which we know has been slowing, so not a shock there. Payroll growth, 3-month average, that's in deceleration. So again, we're monitoring all these things. Unemployment rate has been ticking up, although the last reading was a slight downtick. And then here's personal consumption expenditures, the PCE inflation rate, which we know is migrating down to the Fed's target of 2%. So all of this, relates back to the Fed's mandate of stable employment and full employment and stable prices. And we're getting there. So this composite right here is what's giving the Fed, I think, a lot of comfort in finally making that declaration that interest rates will come down this month. As another data point to the labor situation, we've got the ADP private non-farm employment number. You can see the deceleration over many months, albeit positive. So, again, this is not suggesting that we're having outright declines. It's just the rate of growth is slowing. Unit labor costs, mentioned that those are coming down. You can see that clearly defined in this chart provided to us by the Daily Shot. And so, this is something that we've been watching for a while. This is one of the things that becomes problematic with inflation over time if these wages are sticky, but unit labor costs have in fact come down. So this has allowed the overall inflation number to come down and gives us comfort in estimating that inflation will come down further in the months ahead. Now we'll talk about the Institute for Supply Management. We have both the Services Purchasing Managers Index as well as a manufacturing PMI. And what you can see is very consistent with relatively recent trends on the services side. Everything above 50 represents expansion. Everything below 50 represents contraction. We have seen some slowing in the service component of this index. It remains above 50, so it's moderately in expansion mode, although I would say that it's somewhat tepid. When you get up to 57 to 60, that represents pretty strong growth, but we're just not there right now. But it is in growth. Now, it's a different story on the manufacturing side. We were watching this number earlier this year. We were beginning to anticipate perhaps manufacturing coming out of its essentially its recession, if you will. And it did very briefly, but now we've sunk down in terms of activity. We've seen some notable slowdown in manufacturing activity over the last couple of months. Here we have construction spending. So you can see after many, many months, and this is monthly data here, of expansion, that we finally rolled over. And we've got apartment units that are rolling over in terms of units, starts in multifamily. And this all ties back to overall construction spending. And we do know that the public sector is kind of gearing down to some degree. And also the private sector is gearing down to some degree. And that's why we're seeing kind of this deceleration of sorts right now. One component of the commercial construction market relates to office, and you can see office vacancy data supplied to us here by BCA Research. That number continues to climb at a pretty stout clip. Now, again, this is national data. This is, different regions have different dynamics, but the overall vacancy rate is moving much closer to 20%, which is really putting a lid on that particular component of demand, which helps to put a lid on overall construction activity altogether. We have Redbook same-store sales. I mentioned to you that one of the bright spots, at least for the time being, is consumer spending and consumption. You can see that outlined here. If anything, we have had some acceleration in same-store sales. Now, what does that mean? This just means, these are retailers reporting sales in the current month relative to the same month a year ago. So same-store sales, if you will. So this is not total sales. This is just from the same units. Think like, a Nordstrom, a store in Nordstrom reported sales last year in the month of September or August, and this year in August for that same store they're reporting sales, and this represents that year over year number. And so 5% I would consider to be very strong. Some of that is driven by inflation, so we do know that that's at play. But anytime you see this accelerating at a time where you're getting labor weakness, it's an interesting dynamic. And we also have mortgage rates that are continuing to move down. That doesn't mean that affordability is improving markedly. I'd say we're down, we're getting closer to 6.5. This bank rate 30-year conforming fixed rate mortgage is around 6.75. We do know that prices are moving higher again. And so that is kind of offsetting the benefit that you're getting with a slightly lower mortgage rate than what we've seen here over the last year. We'll talk about the bond market and the yield curve and interesting developments this past week. So you can see here both on the 2-year Treasury and the 10-year Treasury, we've had significant rate declines, and this is by virtue of some of the economic data witnessing some slowing in the economy. And you can see that rates here on the 2-year about 3.7 more or less. This is data that was reported, basically pretty early on Friday morning, so it didn't capture. And Friday had really just modest changes. So I mean, we can use these as a pretty good proxy. But directionally, you can see that throughout the summer we've had a notable decline in rates, both on near-term and longer-term Treasury maturities. This is something that we're going to talk about in the next slide. So these rates in aggregate are really in the same place right now. And in fact, let's transition to the next slide. So, very interestingly enough, Charlie Bolello has identified this for us. It has been 783 days since we've seen a what we call a normally sloping yield curve. That just means that long rates are above short-term rates, and we have been in a negative yield curve situation for 783 days. Now, this is, we've had periods of time in the past where we've had extended negatively sloping yield curves, and you can see here that oftentimes they correspond with recession. Well, we didn't have a recession, and it was negatively sloping, and that's usually one of the indicators. But this past week, we went from an inverted yield curve to a normally sloping yield curve. That's not to say that we couldn't dip back into an inverted yield curve, but for the first time, and think about it, like 2 years, we have gone back to a positively sloping yield curve. So with the current dynamics come the expectations, and this is where the market currently estimates the Fed will wind up when they're all said and done. So when you think about, this broad range of 5 to 5.5, kind of like 5.25 in the middle, that, going back to 2024, it was thought that the Fed was going to like wind up, basically not easing very much. And then that terminal rate has gone down tremendously to about 2.9%. So the expectations of where Fed funds are going to wind up have changed dramatically in just a few months. Now we're going to transition to the stock market, and we're going to just talk about September as a month, typically being the weakest month of the year. You can see that overall returns on a monthly basis, this is an average over a long period of time, essentially 1928 to 2024, almost, but not quite 100 years. September, typically the worst month of the year. So, we've already gotten off on a kind of a bit of a rocky foot here with some pronouncements by some technology firms, and again, not to say that we're going to fall into averages, but I think to expect that September might be a little weaker is pretty well reinforced by the data. In fact, as I mentioned, S&P 500 had a pretty bad week last week, and this is the worst week since March of a year ago, so about a year and a half. And we did have some disappointing data. We did have technology really sell off for a bit, and after many weeks of equity inflows, we did see some equity outflows last week in response to this. Again, I think it's all part of this kind of cathartic kind of regurgitation as the market begins to broaden out and we begin to see better participation from the other 492 or 493 stocks in the S&P 500. Here we have crude oil, and notably weak here. Some of this has to do with OPEC dynamics. Some of it has to do with storage. Some of it has to do with the fact that we've transitioned out of the peak summer driving season. And so demand factors are at play, but looking at basically WTI, West Texas Intermediate at below 70 is obviously from a domestic drilling standpoint is not desirable. I think a lot of drillers would like to see something around the 80 level, and these things are inherently cyclical. But what I didn't include in the chart pack was some of the inventories for distillate products that after crude oil is cracked into its derivative distillate components, that the inventories of those are actually pretty low. So as we transition out of late summer and into fall, I would expect prices to perhaps stabilize a little bit, particularly if we get some geopolitical tensions, which could act as a catalyst for those prices to move higher. Here we have some relative valuations. This data from Truist, which has been pretty consistent for a while. What we've been saying is that the overall S&P 500, from a multiple standpoint, this is the forward price to earnings ratio, 21 times. The average PE ratio is around 16. We've known that for a long, long, long time, and so we've known that the overall index is probably a bit stretched, and it's because of the high-flying AI, very large cap stocks that have an outsized influence. Well, if you get back to looking at the equal weight, and that's just taking out the advantage or the influence of these large stocks and just treating everybody on an equal 1 divided by 500 basis, then you see here that the valuations are not nearly as stretched, maybe a little bit, but not too much. Again, 15.5, 16 times is the average multiple. Well, when you get to mid-cap stocks, they're roughly in line with their long-term historical average, and notably here with small caps, and this is what we've been talking about for at least a year now, is the divergence of large caps to small caps, and that disparity remains, and we are actually cheaper from a forward multiple of earnings standpoint than the long-term average would suggest. And I do think there is opportunity for small caps. I think we need to settle out in this a little bit of this economic downturn, and I think particularly with onshoring and things like that, that there's a real opportunity for small caps to witness some outperformance. And I do think overall I do think that overall performance from all the areas outside of the AI stocks, I think that not only will earnings, which we saw last week, earnings performance will look better relative to the Magnificent Seven, but I think the stock price performance will look better relative to those as well. Here we have a little bit of a busy chart, but this is, again, just looking at the next 12 months or the forward PE ratio, and it's looking at different themes and sectors. And this is just an emphasis chart to my comments on the prior chart, is just showing you that growth is really expensive relative to the last 10 years. And when you get down to small caps, it's relatively cheap versus the last 10 years. And S&P 400 is mid-cap stocks. So again, as I showed you, there is some value in mid and small caps here, relative to growth. And the overall index is overvalued right now. What's interesting here is dividend aristocrats seem to be highly valued as well, but dividend growth rates have been accelerating in many cases as people are accelerating returns to sharebholders, and value maybe a little bit above the trend line, but an equal weight, as we mentioned here, pretty much in line with its historical averages. So, I think the takeaway is that really the most attractive areas of the market are mid and small caps. I think they just need a bit of a catalyst. It's not an area that you want to jump into headlong when you're in the transition period to a slower growth economy, but once you get into that environment, they tend to become a lot more attractive at that point. Here we have volatility as defined by the VIX up here. This is the spike that we saw in August, and it was a rather notable spike. Here you can see that we've kind of transitioned to a little bit of a higher overall volatility with a recent spike above 20. This provides opportunities for pricing within the structured product markets. At some point, it provides opportunities to get into new sectors that might be beat up a little bit, but also it's going to result in days a little bit like maybe what we've seen here lately, where you get down 1%, up 1%, on a more kind of a consistent basis, if you will, rather than these smaller movements that we were getting really used to heading into the summer. So here is the median annual path of the S&P 500, and this is really meant to show you the impact of presidential election years. So a few charts back, I showed you the fact that September tends to be a weak month, but when you get into presidential election years, you tend to have a prolonged period of weakness that may last a couple of months. And not to say it's going to happen this year. There is a lot of uncertainty because this race for the White House is very, very close. But usually, when you have elections in presidential cycles, you get a bump in the market following the election. There's a relief factor that kicks in. At least you have some sense of where policy might go, particularly if or may not go for that matter. If you wind up, and we could very well wind up with this year, where depending on who's in the White House, you could have a split Congress, and that generally means that large kind of tectonic policies changes are not likely to happen. And so, but I just kind of show you this from a historical backdrop that your natural rate of the natural rate of growth for all years going back to 1984 is for something that looks a lot more linear than it does during presidential cycles, when you typically get a little bit of weakness here in September and October. Show this chart for maybe a little bit of impact because it kind of speaks to our desire to want to minimize volatility. And we use this example a lot, and it's a pretty obtuse example. But if you're at $100 a share in a particular holding and it goes to 50, well, that's a 50% drop. But if you're at 50 and you want to get back up to 100, you need a 100% increase in that holding to get back up just to where you were. And so percentages do matter. And as people look at performance, I think something that we have definitely made a hallmark of our philosophy is to try to minimize downside volatility. And we have some notable cases here at various points in time where we've seen some rather significant drops. And these numbers for NVIDIA back in March of this year, that represented a $279 billion market cap decrease. And when you're talking about like maybe all the way to $100 billion of market cap decline, that's significant volatility that we are actually trying to avoid. And so, you avoid this in many respects through diversification. And you mitigate this by diversifying not only amongst other stocks and sectors and themes, but you also get it by mixing in other asset classes as well, whether it be bonds, whether it be gold, whether it be private credit or private equity. It all serves to mitigate the downside exposures, and of all the celebration that a lot of people that hold NVIDIA have, and they've done well, mind you, but in 2022, NVIDIA was down 50%. So just keep that in mind as we think about volatility in the months and quarters ahead. This chart shows us essentially the increase in volatility on earnings report dates. And you can see kind of a line of best fit is probably like this. But what we've seen in the last few quarters is increased volatility when companies report on the day that they report, or in the case of somebody that reports it after the market, it'd be the following day. But we've seen a lot more volatility in those stocks lately, so people are kind of still hanging on the edge of their seat, if you will, on a lot of these announcements. And finally, here, thought I'd show this chart to kind of highlight the transition that we've been witnessing for many, many decades as we have fewer defined benefit plans and more defined contribution or 401k plans. And you can see that we've actually had a fairly stable increase over many, many decades. Now, we did have some flattening out as we were entering the new century here. Some of this had to do with the tech bubble and the multi-year, or multi-year market malaise that we had. But then that reaccelerated. We've seen a consistent trend, upward trend in the use of 401ks as a retirement vehicle. That's all we have today. Hope you've enjoyed the chart pack. Have a wonderful week, and we'll talk to you again soon.